Hello to everyone. Today I am here with Introduction to Managerial Finance Part 6. If you are interested to have update videos on banking and finance related topics, please do subscribe my channel. In this session, we are going to discuss the return on equity, return on capital employed, sources and uses of cash, the managerial versus standard balance sheet. The profitability check. How profitable is a firm profitability measure we have discussed in the previous session that include the profitability of its equity capital that is contributed by the owner to the end called as return on equity. Return on equity is equal to the net income available to equity holders divided by owner's equity. Owner's equity include capital, common stocks capital, thereafter retained earning, reserves, etc. The profitability of its invested capital measure after-tax profitability of invested capital. We must use the after-tax profit generated by that investment, the firm's after-tax operating profit, which is equal to after-tax profit. EBIT is earning before interest and tax multiplied by 1 minus tax. Here, we do not consider the part of interest paid against the capital debt. The return on invested capital equals to after-tax operating profit divided by invested capital. Invested capital includes the sum of capital equity and capital debt. Sources and uses of the cash. A firm gets the cash from the three sources: from its operations when the customer pay the invoices that were sent to them, for the selling asset and investment decision, or more precisely, a de-investment or the asset disposal decision. Sometimes we have to bring the new technology to our industry, so we used to sell our previous assets. From the borrowing or issuing the new shares. Now, on one side, it's a part of financial decision. In order to meet the capital requirement, either we borrow from family and the friend, from directors, associated companies, and from financial institutions, or we issue either debt instruments in the shape of bonds or float our equity instruments in the shape of shares. Here we have a comparison between managerial balance sheet versus the standard balance sheet. First of all, we have the invested capital or the net asset that include the cash, working capital requirement, operating asset less operating liabilities. It gives us the picture in order to require the working capital, thereafter net asset. Now, the capital employed include on one side the short-term debt and on the other side the long-term debt. Long-term debt plus owner's equity is the total capital employed to the investment. On the other side, we have in, as a part of standard balance sheet, we have assets that include cash, operating assets. Operating assets include account receivable plus inventory plus prepaid expenses and net fixed asset. On the other side, we have short-term debt, operating liabilities that include accounts payable plus accrued expenses, and thereafter long-term financing that include the long-term debt plus owner's equity. Now, it's a short video on the managerial finance. If you are interested to have further videos on the similar topics, please do subscribe my channel. See you soon with the upcoming video on new topic.